Hi, this is Derek Schwartz, host of the Advisor Lab. On today's episode, our guest is Callie Cox, Chief Market Strategist of Ritholtz Wealth Management. Thanks for coming back on the show, because I think we had you on in 22 when you were still at eToro. And I know he and I are both Syracuse alumni. So different, of course, different times. He's obviously much younger than me, but it's just funny because I obviously big Cuse basketball, and now we're, playing UNC and Duke, and it's awful. We're so bad. We're getting killed. And we were a good program with Boeheim. We had 4 decades of, and now it's like the worst time to be in that conference. But I'm sure you guys are enjoying it. The Tar Heels are awesome. And now you've got Bill Belichick.
Not this season, but
Well,
yeah.
you got Belichick, right? So I grew up in Boston.
Yeah.
About an hour really outside of Boston. So I'm a big diehard New England Patriots fan. And I thought, no, I'm going to be a big UNC fan following them with
Yeah.
the football team, which was totally out of left field.
Oh, it was.
Excited about it there? Do you hear like a lot of buzz about it?
Oh, yeah. They're already selling cutoff hoodies at the student stores. But the alumni are really pumped about it too. And it came out of left field. So my husband's dad is like a booster basically at UNC.
Yeah.
So he hears all about the coaching news. He heard about Mac Brown before it was announced. He's really into football too, so I hear his opinions all the time. And when he heard about the Belichick news, he was like, no, no freaking way. Like, there's no way. We got to go with somebody who's younger. Like, we already tried the old dude thing. Mac had some conflicts with the administration, and Matt's dad was like, no, we have to go with a young guy. And then like the momentum kept picking up for Bill, and I think there were some boosters who were like, you have to do this or else I'm pulling my money. Like, we have to
Serious?
make some kind of change. We have to like basically
Yeah.
buy this call option
Right.
while it's here. And it happened. I think everybody is still in disbelief, but we're like, oh shit, this is cool.
I
We're gonna have
know.
Bill Belichick as our coach. It's awesome.
Right. I mean, he's basically the greatest coach ever in professional sports. Anyway, I mean, obviously John Wooden had like 13 championships or whatever with the UCLA or whatever, but yeah, it's incredible. No one saw that one coming. And
No, and it's
because
very
everyone thought he
forward.
was going to stick around he's pretty close to breaking the all-time win record for coaches in the NFL, and that, he's a big history buff, and that he wanted
Hmm.
that, and he was looking for a team that was kind of on the verge of becoming great, but just needed a couple more pieces, and
Yeah.
but no, good for him and good for you UNC fans. So that's so cool.
Yeah. Like from a forward looking, so I've thought about this a lot. I think about everything a lot, but with where college sports is, like moving into NIL, seeing what that new world is, I
Mhm.
actually think it's a great hire because he came from the NFL and because he knows how to monetize. Um, of course we haven't seen him in action, but I've really warmed up to the idea. And I don't know if you know, but Bill Belichick's dad coached at Carolina.
No, I always knew he was at Navy, right? Um,
Hmm.
and because I did read a book of Bill's or some dynasty book on the Patriots. I thought his Navy was like the team that he coached for a long part of his career, but I didn't know he was at UNC as well.
He was an assistant coach at UNC way
Okay.
back when. In fact, there's a picture of Bill Belichick as a kid in like
Yeah.
a Carolina sweater in
Oh,
Kenan
no
Stadium.
kidding. Oh, so
Yeah.
that's
So I heard that. I was like, okay, yeah, I like it. I like it more.
that's
I
so
get it.
well, that's a good segue, I think, with respect to kind of how the college game has changed, and all these players can move with the portal and the money and the contracts, and the investment market has just continued to change. It always does, right? But
Hmm.
following your posts, your blogs, your research, and obviously you spend a lot of time sort of really addressing what the trends and happenings are in the market. I guess first, just give us a little bit of your perspective, right? Like, we've just come off this massive administrative change, right? With the new administration, uh, the president's just going like chapter and verse through everything. I know you did
Hmm.
a big blog about some of the potential blowbacks of all the layoffs and the cutbacks in the federal spending. And just the volatility and uncertainty it's creating, like just a little bit about sort of how you're seeing this and how advisors and their clients should be kind of preparing themselves or thinking about it.
So it's been a challenging time. I don't think I'm the only one that's saying that right now.
Yeah.
There's been a lot of there have just been so many headlines to digest on the economic front, on the policy front. Um, I mean, last year it was very challenging because we were already going through this shift in interest rate policy. And for a while there, the economy really, I don't want to say was on the edge because I think that's a little dramatic, but you could see the slowdown happening in the job market. And one thing you'll notice when I talk about my market views, I constantly go back to the job market and to the health of the US consumer because consumer spending is 70% of the GDP. You have to be thinking about the consumer when you're thinking about the future of the economy. So we were already at this tenuous point in the economy. I think we've strengthened a bit since the Fed started cutting rates, but now we've thrown in this policy factor, and there's a lot of noise coming out there. So obviously, we've gotten a lot of client questions about it. Our advisors have been rock stars. As they are, they're very good at balancing the right amount of empathy and understanding with what exactly is going on. But you know, I always go back to what I know in a situation that feels out of control. And that's as a firm, that's where what we're really emphasizing to our clients on the research side, but also on the planning side. We're constantly saying this is the process. This is our investment philosophy, first of all. We think simple beats complex. We believe the stock market helps you build wealth over time, especially when it comes to fighting inflation. We believe fixed income is a good protection mechanism against all of these unexpected scenarios. And, we have a very evidence-based, scientific, just grounded process in keeping you invested and moving you towards your goals. And we're not straying away from that, even though the world feels like it's spinning out of control. I take on the research side, I also take a grounded fundamental approach too. And a lot of people do, but there's extra importance now in explaining that when there's a lot of speculation, but really not that much that has been implemented or done that could impact the economy. Now, that changed a week ago. We saw pretty massive layoffs in the federal government. And like I said, the job market is important, but for the most part, we're trying to be extra smart about sorting signal from noise.
You mentioned in some of your research that the rally has legs, and I know you'd talked about, though, it's very rare to see 3 years of 20% type returns consecutively. Vanguard put out an estimate the next decade is going to be four to six at best in equities. Saw something similar from Goldman Sachs. Everyone is sort of like, well, higher for longer. Equity returns are unlikely to give us another unbelievable double-digit decade. But you seem confident, or at least your firm does, like, yeah, but this rally can continue for some time. With advisors and their clients, like, what's the sentiment that you kind of are picking up on? Are they optimistic? Are they just complacent? Um, how do you kind of frame the messaging with them about sticking with sort of what's been true and tried?
Yeah, that's a really good question because I'm not sure there's one word that could sum up the sentiment right now among our clients and among the everyday investor that we see out in the world. I mean, going back to the targets, we don't do targets. We actually dissuade our clients from focusing too much on forecasts, like the one we saw from Goldman Sachs or the one that you mentioned from Vanguard, because I mean, nobody knows what the future holds.
Right.
I like
And
to
they
joke
have
that I
they
had
have
a
to put a
crystal
number out. That's what they do.
and that too. It's a marketing tool, and you have to understand the incentives behind those forecasts you see. It is very alluring to have somebody step out and say, I think this will happen in the future, and here's my math. And sometimes that math proves true, but it's not because this forecaster was prescient enough to calculate it right. It was just by chance. So, We got a lot of questions around the Goldman Sachs. I think it was the 3% return over the next 10 years or 3% annual return over the next 10 years.
Right.
We had that conversation with clients around, understanding where these forecasts come from, but also, understanding where we are in the market cycle. I mean, obviously, we've had two 20% up years in the S&P 500. We try to stress to our clients that we also hold international stocks, so the S&P isn't the best benchmark to look at. But it's been a really good 2 years for the stock market and a really good 2 years for your portfolios. And when you take a step back, most people's goals don't require 20% annual returns to reach them. In fact, if you're getting 20% year after year, you're probably taking on a little too much risk and you make yourself vulnerable to a 20% down year or a move that doesn't sit well with your sanity. So, we've really tried to set expectations among clients. And look, a lot of our clients are happy with where they are. They recognize that their portfolios have done well and that they have some room to breathe right now. If we get a more muted year, that's okay. If we even get a year where stock prices trail off a little bit, that's okay too. We're diversified. We're aiming for consistency and stability here. So that's what we hammer in. Hammer is not the right word. That's what we emphasize with our clients. You want consistency, you want stability. These past 2 years have been great, but in the name of consistency and stability, you have to realize that this will probably moderate over time.
So you're very keenly aware of obviously that the performance has been great, and there's been plenty publicized about how concentrated the performance is with the Magnificent
Mhm.
Seven, and the market has shrunk. Publicly traded companies have been reduced by, I don't know, 8,000, 7,500 back in 96 or something, down to less than five now. So you've got fewer companies and they're getting bigger. So there's a concentration kind of volatility that plays out in the equity markets. Um, and what we're seeing, a lot of folks are seeing is, people looking to diversify away from some of that risk. So you mentioned the international exposure. I know gold keeps hitting new highs, which is
Mhm.
typically sort of not a red flag, but a sign of, maybe some fear around inflation, guns and gold. No one knows what to do. Go to the most, certain asset. Are you looking at that as well? Does that sort of kind of frame how you are thinking about what you should be kind of, how you should be recalibrating your portfolio?
Yeah, so I'll start with international stocks because that's been something we've been very vocal about. Uh, we we are looking more at US stocks right now because, we think that there are some structural differences between the US and the rest of the world. I mean, obvious, differences in technological innovations and profit growth. So we're tilting a little bit more towards US stocks right now, but we are very we so believe in global diversification. And I think you can make a really strong argument for the protection that looking globally provides you, especially in this world, as you said, of, really big tech companies and this high concentration that we're seeing in the stock market. I mean, one thing that always strikes me is there's a pie chart that we show clients, and it's sector weights in the U.S. versus developed markets versus emerging markets. And the U.S., of course, is the biggest sector is tech by a mile, but in developed markets, the biggest sector is banks, followed by, I believe, energy or maybe industrials. So there's a lot of sector diversification you get there without even realizing it. And I think that's going to be a really important theme as we move into this year. In fact, it already has been. I mean, the Magnificent Seven is flat to slightly up on the year, but developed stocks are up 8 or 9%. So, I feel like international stocks have gotten this bad rap recently. Why invest in the rest of the world if the US is just running so far ahead of everybody else? But the reality is, I mean, you are a risk manager when you're talking about client portfolios, and there are a lot of really important diversifiers that you can only get globally. Plus, I mean, valuations are really attractive there. And at Ritholtz, we like looking at value because we want to provide that stability and consistency. So that's international stocks. In terms of portfolios and, looking outside to alternatives, mean, we have clients who ask us about a lot of different strategies and we'll entertain them. But generally in our portfolios, we try to keep it simple. We believe stocks help you build wealth and bonds help you help protect you, especially behaviorally as you're building that wealth.
Mhm. And so when I mean, obviously you can't avoid the US if you're buying stocks.
Mhm.
And like you said, they've been the engine kind of surpassing the other markets. Now with this sort of general consensus of higher for longer, our cost of interest is higher on our 36 trillion of debt, right? If Trump gets his tax cuts, the deficit will get even worse. Tariffs could potentially lead to higher inflation for longer, right? Um, does that does that lead you to think maybe this is really time to cut some exposure in terms of U.S. equities? They've had their run; it's been great, and that's kind of driving you towards sort of that global equity allocation, or has that just been a consistent part of your template with the way you manage money?
I think it's an important reminder to stay diversified. Look,
Yeah.
it is really, as you just said, it's really hard to cut exposure to US stocks because they have worked for so long. And where we're sitting right now, I mean, the alternatives don't look great. I mean, I was just talking about international stocks, but a lot of the globe is struggling with the same problems we are in terms of austerity, in terms of, in uneven economic growth, in terms of political volatility. So it's not if you're not investing in U.S. stocks, the next question you have to answer is where is that money going? And I think that's a really hard question to answer. So the way that we think about it is this. We have to go back to what we fundamentally know. Obviously, government debt is becoming more and more of a crisis as the days go on. But at the same time, when you look at it in context, compare it to, government assets, compare it to the growth we've seen in the American population, consider that this isn't irresponsible, this isn't irresponsible debt accumulation. I mean, we've seen huge growth in the American population, and we've been through a lot this past decade and a half. It's not as simple as, just pointing to 36 trillion in debt. So, where we sit is we could see that start bleeding into, and we might have already seen that start bleeding into yields. We could see it bleeding into short-term yields if people start getting nervous about, the credit quality of the US. I think it's also affecting long-term yields and that there's a lot of focus on the deficit right now. And uncertainty is finding itself into, 10-year yields and parts of the curve that a lot of investors own. But I think it's really hard to say where the trouble is. So we try not to, or, when government debt hits that level of trouble, that should make you concerned about your portfolio. So we try to be smart about, again, where we diversify, where we put client money, and, just watching for these signs of credit deterioration. I mean, we have a debt ceiling fight coming up in April or May. I think it's important to, see how the market reacts to that.
So if you are going to have to be selective about where to put money in the US, obviously AI, artificial intelligence has to be like the first thing everyone's got on their dance card. Is it a bubble? Is it not a bubble? How do you think about it in your research and covering this area of the market? It's obviously China with DeepSeek, and what do you think is the best way to be exposed to it? Is it something you should pause? Like, how are you thinking about that?
Well, I don't use the B word. I'm very intentional about not using the B word because I believe very strongly that you can only see bubbles in hindsight.
Okay.
And while valuations, of course, are important, we track them over at Ritholtz. I mean, we talk about them a lot. You also have to view those in context, right? Earnings growth in the S&P is expected to be double digits this year. Companies are making the profits that back up these valuations, and it's not a stretch to say that investors are investors are anticipating a story that could actually come true.
Hmm.
That's not something we could necessarily say back in the late 90s and the 2000s. Although it's interesting, right? Like in the late 90s, everybody was excited about the internet, and it turns out they were right. They were just about a decade early.
Right.
So, AI is one of those stories that's obviously compelling. I don't think you can, read through the headlines we've seen of the past 2 years and say that AI isn't going to change the world. In terms of investing in it, of course, we don't do a lot of active sector selection, but we've had a lot of clients ask about AI, and we're like, look, it has potential to change the world. You can already see it popping up in sales and profits in certain companies. Has the trade gotten ahead of its skis? Probably. I mean, we've seen a lot of money gravitate toward big tech, and now the bar for tech and other companies tied up in the story is super, super high. And already this year, we're seeing investors sour on the fact that big tech is spending a lot of money on AI projects, which shows me that it's not about the story. It's more about where these stocks are trading and how certain the story is with how much the stock market has priced it in. So, of course, we think AI is compelling, but we also think a diversified portfolio is the way to step forward into the future. And if the story takes a step back, as a lot of young and growing stories often do, then you want that protection so you don't feel this massive almost snap back in expectations that we saw in the late 90s and 2000s. And I'm not saying that that's where we're going, but what I'm trying to say is it wouldn't be surprising to see a snapback in the story or a step back where people say, things are changing really fast and we're not quite sure who the winner of this story is.
And I'm sure your, approach or your message to your clients is that sometimes it's healthy, right? To get some pullback, to see some level setting, right? I mean, I was just starting out as an advisor in '99 at Merrill Lynch when the bubble popped in March. Sorry for using the B word. And yes, there was a lot of wealth lost, but it did, sort of set things up for a lot of wealth to be built. And post financial crisis has been an incredible run, just like the run they had from '87 to '99. And so these things do tend to just go up and to the right. And I'm sure. And so that leads me to what I want you to talk about a little bit. And that's really the behavioral finance part of it, right? Because as much as you can show the evidence that at the end of the day, the market goes up and to the right, and if you buy equities, you're probably going to be somewhere between 8 and 10% a year on your money, which is great to beat long-term inflation and put aside the volatility. But then you get advisors, right, who have clients who are now the boomers, right? 10,000 retiring a day, et cetera. And but they're going to live longer, right? Like these people
Hmm.
are living a lot longer. My mom's 81 and I don't see her slowing down. She's swimming 35 laps a day,
Yeah.
right? Like, so, how much exposure do you still want to have in equities? Bonds have not been a bargain, right, Callie? They've
Mhm.
kind of stunk the last decade. I think I saw the Barclay Ags average like 1.6% annually. So it's
Mhm.
not doing, and you wrote this in your blog I saw back in January, they're not the parachute that they once were. How do you deal with that? How are your advisors dealing with that? Because that's tricky with these clients because they still need return. I know you're getting more yield now in the fixed income market, but it's not giving you the kind of safety. How do you manage clients and their attitudes about that?
Yeah, that's a really good question. And I can tell you what we do on the research side. And I'll also say our advisors are absolute rock stars. They're behavioral finance ninjas. They know you know they know how to talk clients through these unique scenarios. And I agree with you. Things are changing really fast. And there are topics that come up every day for us where, you know, somebody like me as an analyst, I hear them and I'm like, wow, I never thought that a client would have to think about this, but here we are. It makes our jobs so interesting and so fulfilling. On the behavioral side, again, I go back to what I know. And I acknowledge the fact that it's a lot easier to see numbers on a spreadsheet than, actually invest the money. But you're right. The stock market has gone up over time, but that also doesn't mean it's gone up in a straight line. We've seen 13, I think it's 13 recessions and 11 bear markets since 1950. And, those aren't just blips on a page, right? Like while we were investing in those bear markets, that was a lot of pain. That was job loss. That was worries about the future. That was worries about our health in 2020. We exist to help our clients make it through those big moments while understanding how they can best invest through those big moments. And it's not easy. I was talking to an advisor yesterday, and I was just talking to him about the environment that we're in and how, a lot of people are talking about an incoming sell-off, which, by the way, stocks will sell off. That will happen. Just understand that as you're investing. You need to have a plan for when stocks will sell off. But he was like, I actually love it when stock prices fall. He's been very intentional about creating a crash plan for his clients. So when prices fall X%, then we need to start thinking about Roth conversions. We need to start thinking about deploying cash on the sidelines. I'm actually considering working with him on, creating this informal crash plan for our Ritholtz advisors. But um, crashes are one of the best times to invest if you're a long-term investor. You just have to get over that behavioral hurdle. That's obviously not true for everybody. Younger investors like me are accumulating, and, crashes are like rain in the desert, especially after such a long and strong bull market. But, if you're on the other end of the spectrum, you want stability, right? And the way that we solve that is we, of course, keep our clients informed. I think the division between research and advisors is really important. We give advisors the ammo they need to have discussions with clients and to understand, what we can offer on the portfolio side for all different types of clients. And then they pick that up and they do what they do best. They tailor it to clients. Um, the bond market is another tough one because, like you said, I mean, investor parachutes aren't working as well. When inflation is the worry, then, fixed income doesn't act like it usually does. Because of course, fixed income is fixed income. It doesn't look as attractive when prices are rising quicker than rates. So, there, I think it's really important to be active in your fixed income exposure. Understanding exactly why you're holding it, not taking anything for granted, remembering that long-term treasuries are the traditional hedge against economic crises, but economic crises also look different. Sometimes we're in an inflation crisis, like we were in 22, and you have to think about things a little bit differently.
Mhm. Before we wrap up, I just wanted to get your perspective, in the sense of the financial advisors today that you work with at Ritholtz and their clients, like how much do they have to change the way they're talking to their clients? How frequently? Like my listeners, as you know, are mostly advisors themselves. So,
Mhm.
great takeaways for them is understanding something they can go back to and implement in their practice. From that perspective, as someone who's an expert of covering the markets, working with an immensely successful firm like Ritholtz Wealth Management, um, and I know you guys have an unbelievable podcast with the animal spirits folks with Ben and Mike. Which is great. How should they be approaching things differently to
Mhm.
compete, to get clients or to keep clients? Like, has anything dramatically shifted in your view that you're like, yeah, if someone's starting out today or they're already building, but they want to really get to the next level, like, here's what I see you need to do. You need to implement maybe this or that. Is there anything that sort of jumps out to you that you're seeing in that regard with all your experiences?
Well, obviously, get active on social media. I'm biased in saying that, but the reason why TCAF, the Compound and Friends, is so popular, and the reason why Animal Spirits is so popular is because our team did the work to build those brands.
Right.
And we built solid brands, not just in the context of followers, but also in the context of trust. We really pride ourselves on bringing smart, quality insights to everyday investors. And it's harder than it sounds, right? It's
Work. It's a lot of
I
work,
it's
right?
it's a lot of work, and there are really cheap, easy ways to get there, and taking the cheap, easy way might work over weeks and months, but look, we've built these brands over years. We understand that there are no shortcuts. But being active on social media, even though social media has changed a lot over the past few years, being active is just such an easy way to get your insights out there. And it may not pick up, it may not catch fire at first, but just being consistent out there and leading with empathy as well. I say all the time right now, we're in a bear market when it comes to empathy because it seems like people are more robotic than ever. But we're also hurting. We're needing something, right? And as financial advisors, we're not just we're not just these money stewards, we're almost life coaches in a way.
Yeah.
We're helping our clients understand, one of the most emotional, one of the most important parts of their lives. Like there's a lot tangled up in that. So get on social media, just start posting thoughts, lead with empathy, just show who you are and what you're posting. I truly believe in that because, I think the finance industry has pushed itself to a point where, we present as this industry being devoid of empathy, and we're not. Like we're all these humans trying to figure out where the world is going, just like our clients are. So, and I'll say too, I think there's a lane on finding new clients, but then there's also a lane on, serving your clients in the best way possible. And what we've done at Ritholtz is, of course, we've tried to strengthen the relationship between the advisor and the investment committee in our portfolios. We never want an advisor stepping out and talking to clients and, just saying, this is the portfolio. This is what you have, like take it or leave it. We want them to be able to explain why we're investing the way we are and how market moves have fit into that. And once we've done that, you can properly set expectations with the client around, what this portfolio is supposed to do in good times and bad times and how it'll effectively help you reach those goals. It's promoting a holistic view that includes the portfolios as a component that you can talk about. And that's what I'm focused on at doing. That's what I'm, doing at Ritholtz. That's what my job is all about. So yes, we're very loud publicly. We have very strong brands, but a reason why Ritholtz has been so successful is because we are smart about how we are stewards to our clients, especially on the investment side.
Your point about explaining to your clients why, I think that's really critical. I remember hearing Nick Saban say the difference between coaching today and what I could do 20 years ago is I can't just tell a player to go do this and shut your mouth and do it. I have to explain
Hmm.
to them why. And that's just a generational thing, perhaps. Right. But the other point you made about the advice you're giving, like be human. I think that's critical. And you're right. All these tools we have are making us more efficient, but they are dehumanizing some of the experience that people have with the engagement. It's like I get somebody the other day who sends me, "Hey, want to chat about your recruiting efforts? Use my Calendly and set a meeting." And I'm like, I haven't talked to you in like a year, and you're asking me to use your Calendly, get on. Like, I know Calendly's useful. I use it, but like some things are
Hmm.
better. Like maybe just say, "Hey, what's going on? Would you love to catch up with you first before you send me your Calendly link?" It's like your process that you're involving me in. I think advisors should be using social and all those things you said to build brand and to get more eyeballs and things like that. But you have to balance it with like, you know, being being a person and not just I get an email from I'm not going to name the firm I have my money with, but I get these emails and it's like it's automated, it's processed. And they come out to me and it's their research and it says it's from my sales guy, my broker, right? But I know it's not. It's just an automated thing. And so I never look at it. I mean, if my advisor sends me something and I know it's actually from him, like, hey, I wanted you to take a look at this. I thought you might find it interesting. That would go a long way, more than it would ever, because no one does that. And I think that's
Hmm.
kind of what I'm picking up with what you're talking about. And that's definitely something that's going to make you stand out now, probably.
Yeah. And let me just say now, Ritholtz does that, and we take that kind of communication very seriously. We want to be there when markets are selling off and our clients are worried because they're reading about all these nebulous headlines about policy and the economy and the future and interest rates. We want to be there. I mean, I think advisors sometimes fall into the trap of, we don't want our clients focused on short-term moves. So like we'd rather not reach out here. We don't want to panic them. And I totally understand that. But I also think, first of all, your approach with every client is unique. We get a lot of clients at Ritholtz who have found us through Animal Spirits. So they're watching these market headlines. They're seeing
That's what
what's
they
going
talk about
on.
every day, right? The weekly trend, what's happening.
Right. So we can't just act like it's not happening. We need to give our advisors the tools to respond to that if a client does ask. And, we think that there's an opportunity in being a little more nuanced than saying stay invested. Because yes, that's the right advice 90% of the time. But when you have a headline coming out about like a pandemic, like COVID, where we were all freaking out and worrying about our health and safety and our jobs and our incomes, you know, the answer is not stay invested. It looks a lot different than that. And that's where the empathy comes in. That's where you say, we built these portfolios for a reason. And yes, we don't know what the future holds. And personally, it does feel very scary. But the best thing we can do right now is stick to the process we have at hand. And, these are the moments that define your portfolio and define where your money goes in terms of reaching your goals. So, you know, by the crux of my job is trying to fold in the details in our portfolio around messages like that help us bridge the gap with our clients when markets do move or when there is, a pretty an unprecedented event that happens. That's the point where we really shine.
Well, this has been amazing. I think our audience is going to get a lot out of this. I again congratulate you on your success and being with Ritholtz Wealth Management. It's a great firm, great company. Your insights, I love following them, and we hope to have you back on the show soon. And good luck with those Tar Heels.
Yeah, thanks for having me. I'm excited for Chapel Bill.
All right, thanks, Callie.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Cyan Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Cyan Investments nor its affiliates and/or subsidiaries warrants its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Cyan Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Cyan Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.